Hello everyone, welcome back to another episode of the Tax Studio Sessions. In today's topic, we are going to be diving into a topic that I think is on everyone's minds quite a lot, especially in terms of the economic uncertainty. Inflation. Now, I know inflation might sound like a little bit of a dry topic, but I promise you it is fascinating, and understanding it can transform the way that you think about your finances. Inflation impacts absolutely everything from your savings, your investments, your groceries, and even your ability to plan your future. So in this episode, we're going to cover what exactly inflation is, right? How does it work? We're going to get into the basics and start there. We're then going to go into a little bit of history about inflation, how it's shaped economies, and then look at how inflation impacts different types of wealth, as well as the practical strategies to protect your money from inflation. This episode might be a little bit longer, but we're going to dive into some technical details, and trust me, it's going to be so worth it. So grab a notebook or just settle in and let's get started. So let's start with the basics. What is inflation? Inflation is the rate at which the general level of prices for goods and services rises over time, reducing the purchasing power of money. So for example, if inflation is 5%, something that costs £100 today will cost £105 next year. Now, there are different types of inflation, one of them being demand pull inflation. This happens when demand for goods and services outpaces supply. Think of things like the Black Friday sales. When everybody wants the same TV, prices automatically go up. You then have cost push inflation. Now, cost push inflation occurs when production costs rise, like higher wages or higher raw material costs, and businesses pass these costs directly on to consumers. The next type of inflation that we have is built-in inflation, and this is when people expect prices to rise, so they demand higher wages, creating a cycle of rising costs. Central banks, like the Bank of England, target a 2% inflation rate annually, which is considered to be a healthy level of economic growth. If we go into a little bit of history about inflation, right, let's just zoom out and take a big picture preview of how inflation has shaped economies historically. One key point is the hyperinflation in Germany. This happened around 1920. So after the World War, Germany printed massive amounts of money to pay reparations. Inflation spiraled out of control by 1923, and bread cost billions and billions of marks. We've also seen this quite recently, around 2010 in Zimbabwe. A very similar thing happened. The government printed loads of money, and very basic items now cost billions and millions of pounds. The lesson in this is that printing too much money without backing it productively leads to disaster. It is inevitable. We've seen it time and time again. It only ever leads to disaster. Another instance where inflation has shaped economies is in the 1970s. We saw a big stagflation in the UK and the United States. This was in relation to oil prices skyrocketing. This led to higher inflation and stagnated economic growth. Central banks struggled to stabilize their economies without triggering recessions. And again, you would have heard of it, the Great Recession. This is very, very much what occurred. And even in a very modern context, right, something that is crazy to think it's 5 years ago, but very modern, very relative for us today, the COVID-19 pandemic. This disrupted supply chains and increased demands for certain goods. We all remember the debacle of people running and grabbing copious amounts of toilet paper for absolutely no reason, right? An increase in demand for certain goods meant that inflation all around the globe was higher. So history definitely shows us that inflation is cyclical. And I think understanding even very small examples like these is such a great way to help you prepare and to help all of us prepare and protect our wealth. So how exactly does inflation impact different types of wealth? We might get a little bit technical in this, but I do think it is so worthwhile because it affects so many different aspects of your finance, even in ways that you might not know. When it comes to cash and savings, inflation erodes the value of cash over time. So if inflation is 3% and your savings earning is 1%, you're effectively losing 2% in purchasing power. The way to combat this is to use high interest savings accounts or inflation-linked bonds. That way, when inflation goes up, you're not going to be stung by having a low interest bond. You're not going to be stung by having a low interest account. Another way that we see inflation impacting our lives is through investments. Historically, stocks outperform inflation because companies can raise prices to keep up with rising costs. Look for sectors that benefit from inflation, like energy, gas, healthcare, construction. Technology is definitely one that's been up and coming and up and rising. Even I think cars and a lot of sort of motor vehicles or airplanes are things that are going to be very high commodities because they will continue to raise the prices and that will continue to keep the costs up for us. Another element of investments is bonds. You have fixed rate bonds and these lose their values during inflation because their returns don't adjust, right? When inflation goes up, the bond stays the same. Whereas inflation-linked bonds like the UK gilt can help to offset this little dilemma. Another form of investing that I'm such a big cheerleader for is real estate. But even real estate gets affected by inflation, as I'm sure many of you have seen. Properties often act as a hedge against inflation because rental income and property values tend to rise over time. But it's important to be mindful of mortgage rates because higher inflation can lead to higher interest rates, which will mean that your mortgage payments will in turn soar as well. Commodities, assets like gold, silver, and oil, they tend to perform really well during inflationary periods. I remember around the whole COVID-19 couple of years, I heard a lot of people talking about investing in gold, whether they actually went through with it. I know that quite some people did, some people didn't. But again, that investing in commodities is something that you can always rely on, right? People always need gold, they always need silver, and they definitely always need oil. Whether you see it or not, these are essential commodities in life and they hold an intrinsic value in society. Consider adding a small percentage of commodities to your portfolio for balance. It will make all the difference. I understand that it might be a bit pricey, but I promise you it's a worthwhile investment. Diversification is key. No single asset can fully be protected against inflation, but a mix of stocks, real estate, and inflation-linked assets can help you to reduce the risk. So now that we understand inflation's impact, here are some actionable tips and steps to help you protect your wealth. The first one being invest regularly. We've just had an episode on our investment portfolio and about how it's such a wonderful, great thing to do and how it can be considered such a great act of self-love. This applies even when it comes to inflation. Help yourself combat inflation or help yourself at least take steps to protecting your wealth during periods of inflation by investing regularly. Use pound cost averaging to invest consistently, regardless of what the market is saying. Again, the market fluctuates. It will go up, it will go down. You can't control that. But what you can control is investing and diversifying to ensure that you have a steady stream of investment and to ensure that you're not caught out too much by inflation. The second thing would be to adjust your budget. Account for rising costs in your monthly budget and prioritize essential expenses. Another thing would be to review your investments. We've just mentioned this, but rebalance your portfolio annually to ensure that it aligns with your risk tolerance and your inflationary trends. The next thing that you can do, I know a lot easier said than done, but is to increase your income. Inflation can outpace wage growth so fast. And I think we've seen that with the recent COVID-19 issue. There's such a soar in the cost of living and wages are not matching it. So consider a side hustle or upskilling to ensure that you can boost your earnings where possible and as quickly as possible. The next step would be to stay informed. Follow economic trends and central bank policies to anticipate inflationary periods. There are so many great podcasts, so many great newsletters, so many great people and sites that you can follow to ensure that you're up to date with what's happening in the economy, to ensure that you are kept well appraised of the economic trends and the current economic climate that we're living in. Inflation is inevitable, but planning ahead can turn into an opportunity instead of having it as a setback. That's it for today's episode. I think it was a little bit shorter than currently anticipated, and I know that inflation can seem like such a basic topic, but I hope that this is giving you a little bit of an understanding as to how exactly it works, and more importantly, how you can protect your wealth even during periods of inflation. Remember, inflation isn't something to fear, it's something to prepare for. It's always going to be there, so make sure you stay prepared. By staying informed, diversifying your investments, and adapting to your financial strategies, you can not only keep up with inflation, but thrive despite it. I hope you've enjoyed this episode, so make sure you subscribe, leave us a review, and share it with someone who might find it helpful. Make sure you also follow us on Instagram at The Tax Studio Company for more tips, tools, and insight. Here's to loving and protecting your financial future. You've got this.